Welcome to today's market report.
Global equity markets eked out gains on Friday at the end of a tumultuous week dominated by concerns over the Federal Reserve's monetary policy and geopolitical tensions between Russia and the West. Strong earnings from Apple and other tech companies buoyed US markets during the session, but the major indices remained on course for a weekly drop, as did the Pan-European Stoxx 600 index, down 1.02% on the day for a fourth week of losses. Economic reports helped ease inflation fears. The widely watched employment cost index came in a touch softer than expected, suggesting wages may start to cool some from here, according to JP Morgan Private Bank. Hot wage growth has been a key factor behind the Fed's pivot, so if this trend continues, that would relieve some pressure. MSCI's 50-country main world index gained 0.5%, but remained on the brink of its worst January since 2008 global financial crisis, after shedding roughly $7 trillion in value. The biggest issue is the Fed, which is clearly in a tightening cycle. Financial market support is not part of the central bank's agenda, according to Ingalls and Snyder in New York. The only question is whether the markets have fully digested Powell's guidance in his press conference. I would expect the equity and bond markets to find bottoms at some point relatively soon, according to Tim Grisky. The yield on benchmark 10-year Treasury notes was down 2.1 basis points to 1.787% as the Fed's favored inflation gauge. The core personal consumption expenditure price index, PCE, rose no more than had been expected. In the past 12 months through December, the PCE increased 5.8%. That was the largest advance since 1982 and followed a 5.7% year-on-year increase in November. The US dollar has seen broad weakness, which has helped to propel GBP/USD back above the 134 level. Technicians may now look for cable to test 134.30. The euro dollar was failed to defend 111. It will open the door towards 107.75.
This is today's market news. Thanks for listening. We'll see you next time.